Hello, and thanks for joining us today to discuss the macroeconomy, interest rates, and the article Staying Realistic on Interest Rates. My name's Matt Erickson, Senior Analyst with Terrain, and today I'm joined with Amy Hodgson, Relationship Manager with American AgCredit. Amy, thanks for joining.
Thanks for having me, Matt.
So to kick things off, and as we look ahead to 2026, one of the big questions I continue to get from customers is, are interest rates finally going to give producers relief? And the short answer is perhaps maybe a little bit, but not across the board, and certainly conditional based on the performance of the economy and progress on inflation. So as we go through 2026, I expect the Federal Reserve to remain cautious with any rate cut decision throughout the year. The labor market still remains resilient. Unemployment still remains about 4.4%, although it has been cooling within the overall economy. But inflation continues to remain sticky at around this 3.3% mark with regard to inflation. So any rate cut from the Fed should help with operating credit, but longer term rates, tied to land, facilities, and other major capital investments are likely to stay sticky and elevated. So what's going on? Why is this the case? And so, when I think about the economy and the macro economy, altogether, the economy is still holding together. Besides quarter four 2025 GDP, we were still in this range between 2 to 3% GDP growth. When we think about the overall economy and some of these longer term rates, expected inflation over the longer term horizon is still expected to remain elevated. Obviously, the war between the U.S. and Iran is causing a little bit of volatility in that space. We still have continued deficits that we're running here at the federal government in the United States, but also the fact that investors want extra compensation for taking on longer term risks with their capital investments. So even if the Fed proceeds with slight easing, rates may not be doing the heavy lifting for you. So the bottom line for 2026, I believe, is simple, and it's that discipline matters over rates. And what I mean by that is profitability will depend less on where interest rates land and more on, balance sheet strength, working capital management, and how efficiently capital is being used. And so with those opening remarks and kind of the summary here of the macroeconomy, interest rates, inflation, and the article, I think it's really timely here that I bring Amy into the conversation. And Amy, you work with cattle feeders every day. You work with our customers at American AgCredit. And, I want to get your thoughts and reaction to the topic of the macroeconomy, but also what are cattle feeders telling you with regard to what they're hearing, what they're seeing, and what they're concerned about?
I think right now there's definitely some caution with how elevated cattle prices have been for how long. So when is this market going to turn? What event could potentially tip us over that we're not thinking about? That's definitely part of the discussion. And really leverage, Matt. I mean, leverage at these elevated prices, which translates to higher interest expense, is definitely been a top of mind subject for everybody that I talk to.
Yeah, and when we think about inflation, we think about the Fed's dual mandate, and it's really simple for us to say, it's maximum employment and price stability, but it's really hard in practice to implement. And I think what we're seeing here is, while we do see a 4.4% unemployment rate, which is still relatively strong, we are seeing the labor market cool down here a little bit. But again, I think the big concern here for the Fed in 2026 is going to be on the price stability side. And Amy, I know probably one obvious question would be, when you work with cattle feeders, with everything going on globally and some of these geopolitical events, I'm sure the war between the U.S. and Iran is on top of mind for cattle feeders.
Yeah, absolutely. I mean, it could definitely have an impact on commodity prices, but what could it do for the long term or short term interest rate market, Matt?
Yeah, I think when we think about the dual mandate again, one is, I think from the Fed's point of view, I think this is doing a couple things. One is I think we're looking at energy volatility in the marketplace, and obviously that's going to put anytime you've got between 100 to $120 barrel oil. That's going to put potentially some strain to the consumer here if this is supposed to be a wide or a prolonged war. So I think questions in terms of, is this a, 5-day war, 5-month war, a year war? I think the length here is really uncertain. But when we think about interest rate volatility, one, I think, yes, on the energy side, I think that's common sense. It could impact inflation there. But also, oil commodities and energy commodities also trickle down to the services side of inflation as well. So I think, the Fed's kind of in this place now where, one, I think they're probably in a good position to stay put for a lot of 2026. I think the market expectations are for some of these rate cuts to maybe push into the latter portion of 2026 and maybe even 2027. So again, I think the war between Iran. Every economist's favorite word is volatility, and I think it's just that there. So I think this added layer of geopolitical uncertainty. I think it gives more incentive for the Fed to say, you know what, some of this Middle East disruption here, maybe it's wise for us to stay put. Amy, I want to ask you another question too, because one, working with cattle feeders, working with, customers across American AgCredit, one of the most important things is risk management. And when you work with customers, Amy, and you work with them on balance sheet management, working capital, and all these different financial metrics, what do you advise cattle feeders to do in 2026 in order to be good operators of their operation?
Definitely focusing on working capital, Matt. And so they have a cushion when there is volatility, whether that's the with cattle prices, interest rates, whatever it is, that working capital will provide a good cushion uh, for future volatility since we can't predict the future. So that's the key.
With that being said, Amy, thank you so much for joining today's conversation. I hope you all found value into this video. And if you want to read any more about the macroeconomy or other commodities, please visit terrainag.com. Thank you very much.
Thanks, Matt.